Okay, a lot is happening right now. Gold in 2026 is up 13% and crude oil is up 77%. Not only that, Sensex and Nifty is down 11%. And now the Indian government is asking us to
साल भर तक सोना नहीं खरीदेंगे, हमें पेट्रोल डीजल का उपयोग कम करना होगा.
So why is the Prime Minister saying all of this? As you as an investor, amongst all this news, what should you actually do? In this video, we'll cover two things. One, what should your actually strategy be with respect to gold and equity? Second, what is that one investment strategy that you can just follow to keep everything simple and save yourself from everything that's happening right now? By the way, every time the media hypes something and scares you, 01 tries to release a video to explain how you can decode the news in simple terms. But if you're not subscribed, which a lot of you aren't, you won't be able to decode the market. So can you please hit that subscribe button, do yourself and us a favor. So I did not actually know this. India produces about 1 to 1.5 tons of gold a year that we produce right here in India. Can you estimate how much do we import in a single month? In January alone, it was 99 tons. That's in a single month. So obviously, we spend a lot of money importing gold. Virtually all of our gold is imported. And it's imported not in rupees, but dollars. World gold prices are priced in dollars, which means when you want to buy these 99 tons like we did in January, we would pay dollars. And the dollars come from our Forex reserve. Now, India does not want to spend too much on dollars because it costs us from our Forex reserve. Therefore, we have a tariff on the gold, which makes the gold a little more expensive for India to buy. It used to be 6% and now it's changed to 15%. Which means this increase discourages buyers to actually buy gold. I want to explain why in just a bit. Indian gold prices are very interesting because there are two variables here. One is you have the Indian gold prices, which already has the tariff in, and how it's correlating to global gold prices. And then you have the rupee and dollar relationship because as the rupee weakens, the Indian gold in India actually becomes more valuable. Look at this relationship of Indian gold prices along with USD INR. Very simple, you'll notice domestic gold prices are going up. Actually, that's quite a steep move up. And then this purple line falling is actually USD INR, where the USD is becoming stronger against the rupee. So imagine a situation that the prices have not changed, but the rupee continues to depreciate. So when a country uses the Forex reserves to buy a lot of just one thing, it puts pressure on the economy. And gold is the third largest thing we import. The first largest thing, the largest thing is, no guesses here, oil. So I'll explain this oil bit so that we can understand what to do actually with our portfolio right now today based on what the government is also saying. Now within oil, crude oil is 88%. So if India spent 100 rupees on oil related imports, 84 rupees goes towards crude oil imports. And crude oil is like blood for the country. Actually, any country. Energy is how a country runs. So if the prices of oil are going up and they've gone up a lot, it's actually putting pressure on our economy. Now, you're probably thinking, like I was thinking, that India probably has some reserve, right? Some emergency fuel tank we can use because आसपास petrol pump नहीं है. We do. We actually have the strategic petroleum reserves. And when I Googled this, I felt a lot better because there we're supposed to maintain 90 days of strategic petroleum reserves. Then I found out our current sthiti. India has 60 days of crude oil, 60 days of natural gas, and 45 days of LPG stock. Think about this for a moment. This obviously means that we are now digging into our strategic reserves, and that's never a good thing because fuel price is actually linked to the entire economy. Let me give you an example. Over here, we can see when oil prices go up, food prices often go up. The entire value chain from production all the way to delivery relies on energy, whether it's transportation or actually growing the crop. So we can see here recently, headline inflation and food inflation, we've recently hit 3.21% in February 2026, which is a 10-month high. But actually food inflation has gone up but not as much, which means that we've yet to see the impact of crude on food, basically, which means if this continues, we will actually feel the pinch. Let's look at the Forex reserves. So India earns dollars from Forex exports. For example, when we export software abroad, we actually earn in dollars. But when we import something, the opposite happens. We spend in dollars. For example, gold and oil. The difference goes into the bank account that's managed by the RBI, and that turns into a foreign exchange reserve. India has about 11 months of import cover, so the reserve is about 691 billion. That's in March 2026. But 1 month before that, in February, the actual total was $730 billion. That was our reserve. What's really happening is because the prices are changing, we have to pay way more to get a lot less. And that's not good. But this is not the first time. In the past, India has seen rising inflation, gold demand, rising oil. What did we do then? Let's look at history because it teaches us something really interesting. In 1991, there was the Forex crisis where India had $1.2 billion worth of reserves, and this was less than 3 weeks. So when the time came for us to actually use it, we used gold. We took gold, pledged it, and literally got help from the Bank of Switzerland and the IMF, and that's how the country ran. So we do remember a little bit of trauma, but we dealt with it. We don't want to be in the 1991 situation. To be honest, we are nowhere even close. But why wait, right? When we know that such a pressure comes to the economy, we want to lessen the impact as much as possible. Which is why the government is asking us not to do anything that puts pressure on those Forex reserves. A weaker Forex does 3 things. It increases inflation, creates a whole mess for the economy because the costs and profit all goes for a toss, and you also see a weaker currency, import costs, and general volatility. You see, when the market becomes volatile, it will affect your portfolio. And I want to explain, if it affects your portfolio, what should you do as an investor? Here's what you do, and I'm going to back it up with some data. Listen very carefully. We look 20 years of real Indian market data. I have the Nifty TRI. This is the Total Returns Index. It basically looks at Nifty and includes the dividends as well. It's a true picture of Nifty. Then I have gold prices, and I'm also going to include debt prices at 7% return. Now I have taken 4 scenarios. The first scenario is a person investing 1 lakh rupees in equity. Second person is investing 1 lakh in debt only. The first one is equity only. The third person is investing 1 lakh in gold only. And this fourth person, this guy is doing a little bit of everything. This diversified guy. All right? I know what you're thinking. That's not the answer. Look at it really carefully. It's going to surprise you. And what we've done is we've assumed 33,000 rupees in all 3 assets once a year. So it's easier to calculate on an Excel sheet. Person 1 invested only in equity, and as we know, equity gives very good returns, but is it? So you can see 20 lakh became 78 lakhs. That's an XIRR of 12.7%. But look carefully. Don't just look at returns. I want you to look at volatility too. Volatility is that, that heartbeat that goes da-da-da-da when you look at your portfolio, yaar, market gir gayi. If you've ever felt that, yaar, my stock is down. Volatility affects you. So high volatility is a bad thing. Now let's look at person 2. He invested in debt, the 20 lakhs became 41 lakhs, and there's no volatility. All right? Remember, money investing is more about the relationship of risk and reward and not just reward. I think everyone on the internet is saying, invest here, you'll make itna % a year, CAGR. That's not the true picture. Also look at the risk side. Now let's look at person 3. Only gold, his 20 lakh becomes 1.22 crores with the highest XIRR, in this case, 16.47%. And person 4 with a diversified portfolio who has a little bit in everything, this 20 lakh becomes 80 lakh rupees. The volatility though is lower at 10.49%. And it has a good Sharpe ratio. And here, I'll admit there's a bias. Obviously, the gold portfolio will show the best returns because we already know gold has done well. So what I'll do is 2025-26, has this bias of gold doing well. But if you remove those 2 years and check the same data, the results will actually surprise you. Equity turns 18 lakhs to 66.85 lakhs, gold becomes 43 lakhs, and the same diversified portfolio is 48 lakhs. Higher than gold. I'm gonna say this again, higher than gold. The equity also had the highest volatility in these portfolios at 28.38%, gold was 12%, and the balanced one was 8.79%. My point is very simple. Every 10 years, there'll be some asset which will really outperform. You don't know which asset it is. But does this mean that the gold portfolio is the best? Does it mean that the balanced one is the best? Let me show you a chart here. Look at this. You see this beautiful sideways chart? That's gold. Let me zoom out, and if we zoom out, we can see that sideways turning into an upside. That is gold. I want you to see equities. Over here, equities for a long time in a certain period gave negative returns very quickly, scaring the bejesus out of you. But then the opposite happened, it just moved up as well. My point is quite simple over here. If you look at any little period and decide that's what the asset is, you're wrong. If you're trying to predict which asset will do the best based on a moving average and the calculation of all of these quant things, you will be wrong. If you find the combination of all of these two things and you can predict when to buy the stock, you know what I'm going to say, you'll be wrong. No one really knows which asset will do what. If you can divide it and have a diversified portfolio, that's probably a good idea. Now you'll say you already know this, and I completely understand. You see guys, you'll say every time Pratik comes, 01 says the same thing. We have to. Our fight maybe is against you overthinking your portfolio and the media. They make it sound like it's the end of the world, but it's not. In your strategy, nothing really changes. So our job as educators is to come back and tell you it's all right. Look at this data, look at this data, look at this data, so that you can decide. Do me one favor. If you consider yourself a 01er and you've taken maybe more than 2 or 3 episodes and you've liked it, share this video with one person or just tell them verbally. Because I get so many DMs of regular viewers asking me, what should I do because this has happened? And as educators, important for us to come back every single time and remind you so you can be, I'm a long-term investor. If you understand this, put it in the comments. I'm a 01er, long-term investor. If you have any questions, also put it up. We'll answer in the comments. Hope you enjoyed this. Say thanks to the 01 team. Thank you and bye-bye.